For more on this big blue chip breakup, let's bring in Jared Weisfeld, the tech sector specialist at Jefferies. Jared, great to have you with us. I'm interested to get your thoughts. I'm going to start off with the same question that I just posed to Guy. Is IBM, with its announcement today, more like, in your view, Hewlett-Packard or Microsoft when Satya Nadella joined?
I'd probably agree with Guy on this in terms of closer to HP. You know, when you think about what IBM is doing here, they're playing a significant amount of catch up, right? What they're doing today is to effectively hone in on the hybrid cloud market. And they've sized that market at about $1 trillion. And to do so, they need to divest the legacy business that's been declining, call it 5 to 6% a year. And by the way, with that divestiture, they're actually keeping some of the cloud assets. So when you think about what this asset looks like on a go-forward basis, this NewCo that they're calling it, it's probably going to decline a little bit faster than that. So I think there are a lot of questions in terms of what NewCo looks like. There weren't a lot of answers on the conference call this morning, a lot of investor questions on what the pro forma capital structure looks like, how to think about the debt levels across the two. But it seems pretty clear to me that the focus is to play catch up to some of the large CSPs, the large cloud service providers like Amazon, Microsoft, and Google, and they'll do so with a refined focus via M&A. When you think about the $36 billion acquisition of Red Hat, how to leverage that with this new refined structure.
Can they compete, Jared, against all those cloud service providers that you had mentioned that have been in this game for so long, that have dominant market share?
It's going to take a long time, right? I mean, look at Google right now. Google has a ton of resources, and it's a structural growth company, and it's taking a long time to catch up to Microsoft and Amazon from a cloud service perspective. So I think it's going to take time. It's going to take patience, and the growth strategy that they outlined on the call today, they talked about mid-single-digit growth. This is a company that's been growing, 0 to 1% over the last 3 to 5 years. It's going to take a lot to accelerate that growth, which is why I think you'll probably see some inorganic acquisitions associated with that growth profile.
Jared, it's Karen. Thanks for being on. Let me ask you, even if one is skeptical about these two businesses apart and how they'll trade, shouldn't they have done this anyway, even if it has a risk of not working?
I totally agree with that in terms of from the perspective of IBM. This is it's a relatively new CEO, even though he's been with the organization for a long amount of time. But this is the right strategic pivot from the perspective of thinking about how to attack the cloud market going forward. And I think, regardless of the questions on capital structure, et cetera, I think strategically it certainly makes a lot of sense when they think about what the vision looks like going forward and how to attack the hybrid cloud market, right? Microsoft realized that they had this massive install base from an enterprise perspective, and they leveraged that with Azure incredibly successfully. Now it's going to take a long time, but it certainly seems like the right strategic move.
Obviously, IBM is very intent on competing in this business, Jared. So do you anticipate prices to be pressured across the board in cloud?
This is, it's a great question. It's not, pricing is always part of the equation, but if you're the CIO or CTO of a Fortune 500 company and you're talking about lifting and shifting your critical infrastructure to the cloud, price is just part of the consideration. So, you're talking about, 5.9 reliability. You want to make sure that those assets are never going down. So I don't anticipate that being part of the equation.
Jared, thank you. Good to see you, Jared Weisfeld. Tim Seymour, top cloud play.
It's probably Google for me because I just like the valuation there, and I like the other parts of their business. I realize that we've been talking more, and people have tended to talk more about Microsoft and Amazon. But frankly, I like Google's business. I'm long it. I think YouTube is undervalued. And yeah, I think their core business in search has proven to be very, very resilient, and their cloud is good.
All right. Let's turn from Big Blue at the breakup to that money manager marriage. Morgan Stanley buying Eaton Vance for $7 billion. Morgan Stanley CEO James Gorman telling CNBC earlier the move has been in the works for years.
They have an incredible custom product in parametrics, which has been an enormous growth vehicle, very good traditional asset management, large in sustainability funds with the Calvert funds. So there are a lot of, it's an unusual deal in that it's highly complementary. And it's something that we've looked at for several years, and the opportunity knocked and we took advantage of it.
Both stocks moved higher on the deal. Karen, what do you make of it? Do you think Morgan Stanley is more attractive as a business today versus yesterday?
I think it's interesting. I was surprised at, I mean, I know the stock was up a lot. It didn't seem like they were paying that much for assets, and obviously there's a lot of synergies here. So I get what they're trying to do. It makes sense, and now I think it just sets off a land grab. If you remember when Schwab bought Ameritrade, that started off a land grab, and Morgan Stanley, I guess they just closed last week, maybe on E-Trade. So I think we'll see that in the rest of the space. Good timing for Nelson Peltz.
Or are they going deeper into a business that is slowly being eaten away by the ETF business, by robo-advisors, et cetera? Guy?
Yes, I think that's probably true. But if you go back and listen to what James Gorman has said over the years, you know, they want to be in very distinct, I think 3 or 4 very distinct business units. And with this acquisition, he's accomplished that. I also just think he bought himself probably another 3 to 5 years at the helm of Morgan Stanley, quite frankly, as he can now tell the board, you know, you need me to integrate this deal. I do think it makes a lot of sense. I do think Karen is right. There's going to be a land grab. Morgan Stanley was first to this dance. You know, I don't know necessarily that you buy Morgan Stanley on the back of this, but then you look at some of these asset managers that are still out there, and you ask yourself which one is next. I think that's how you have to play it, in my opinion.
And certainly they all traded as if there is a which one is next sort of mentality in the market, Bonawyn. I'm wondering, at this point in time, would you say you would buy a Morgan Stanley kind of business or a Goldman Sachs kind of business?
I still prefer a Goldman Sachs type of business just because of the reputational prowess around their investment strategy. Now, you know, Morgan Stanley, I can understand what they're doing. I think that what you've seen is with SPAC and direct listings, you've definitely seen somewhat, I'm hesitant to call it an assault, but a limited assault on some of the heritage businesses, the fee generation businesses there. So when you look back at bank earnings, you know, the last 2 quarters, and you're talking about trading profitability, I still think of a Goldman Sachs as being premier in class there. And for that reason, that would be my preference between the two for a business that is seemingly transitioning into more of a retail focus.
Tim?
I think this is a great move. I think this is a higher multiple move. I think this is you definitely want to own Morgan over Goldman. And you have wanted to do it for the last 2 years. It's outperformed Goldman Sachs by 15% on a 2-year chart. This is about recurring revenue streams that are fee-based with no risk. It takes away regulatory pressure. It takes away the balance sheet requirements. And again, this is now somewhere around $4.5 trillion of assets between MSIM and what they're managing on the wealth management side. It's massive, and I think they deserve a premium over the others because I think they're going to be able to do more.
Karen, do you think there is another deal in the works when it comes to asset managers?
Yes, I think we'll see one. I mean, if you're, you know, a Janus or an Invesco, you're already under, you know, some scrutiny there. This just adds to it. So I don't know who it's going to be, but I do not think this is the first and only one that we will see.
Come on, let's play matchmaker here. Guy, come on, play this game with me. Matchmaker.
Do you want me to sing? I mean, is that what you're
looking? Not really. You can't unhear things.
You brought it up. I don't think Citi's going to do anything. I think Citi's got their own problems, so they're out of the box. Goldman Sachs is trying to get away from the Goldman Sachs when I was there 15 or so years ago. So maybe they're in play to do something. I think Wells Fargo has too many issues right now. So you have to ask yourself, who's the next big bank that's going to step up? So it comes down to 2. To me, it's either Goldman Sachs or Bank of America, and who they pick, I have no idea.
Yeah. Tim, what do you think?
I think, if anything, maybe they're looking at ETF companies. Think about the assets. ETFs are at record AUM, and I think that's a major investment trend. So think of some of the big ETF houses that are still independent, and I think that's probably the next move.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.